What is the most destructive thing you can do to yourself as an investor? Well, obviously there's lots, but one thing I want to talk about today is very simple. One of the most destructive things you can do investing is not making dividends a key part of your strategy. I know, it sounds really boring, right? A little bit too simple. The truth though is that the data overwhelmingly concludes that on average, dividend stocks, and specifically growth-oriented dividend stocks, vastly outperform companies that don't pay dividends. And they do this on average with significantly less risk. That may not be the most exciting thing you've heard today, but it's a very powerful piece of information if you think about it. Higher returns and less risk. So clearly, not making dividend investing a key part of your strategy sets you up at a big structural disadvantage. The reason that I'm talking about this today is because just last week I finished a grueling 5-month period of analyzing every dividend paying stock on the Toronto Stock Exchange and TSX Venture. In total, there are almost 3,200 companies listed on these two exchanges. We identified 352 stocks that pay dividends, and I went through every one of them, analyzing financials, industry trends, reading conference calls, press releases, and speaking to management. Out of these 352 companies, I pulled out 73 companies that passed the first round of research. Digging deeper, 31 of those companies were singled out as having the best overall fundamentals based on growth, value, and financial strength. And then out of that group of 31 companies, the top 8 stocks were recommended to clients. That's 8 stocks out of an initial group of 352. And this is deep equity research. It's not just using stock screeners or digital financial data. It's learning a little bit about every company and a lot about the very best companies. Doing this is a huge amount of work, but it's always a great experience. I want to share with you some of the things that I learned researching all of these companies over the last 5 months. I'm going to do this in another video that I post later this week. But right now I want to just go back to the data and what it says about dividend investing in general. You can see the outperformance illustrated here. Dividend growth stocks vastly outperform non-dividend paying companies over this 30-year period. 11.6% average annualized returns compared to only 0.3% on average per year for non-dividend stocks. But they're also substantially less risky as shown by this chart. Annualized volatility over 30 years of 13% for dividend growth stocks compared to 23% for non-dividend stocks. So once again, far less risk and far greater return. I know it's not the most exciting advice, but if you want to set yourself up for success investing, then you need to hear this. One of the biggest mistakes you can make investing is not making dividend stocks a key part of your long-term strategy.